Stocks started the day in positive territory, and they appear to be back just barely here. Michael Vogelzang is President and Chief Investment Officer of Boston Advisors, where he manages $1.7 billion in assets. He usually joins us from Boston, but we're lucky enough to have him here in New York today. He stopped by our studio. Good to have you here.
Hi. How are you doing, guys?
Good. Interesting earnings. So far, you know, JP Morgan's the big one today. We got Alcoa kicking it off. Investors didn't seem to like the numbers so much.
Yeah, you know, it's always this interesting time because everybody's on pins and needles waiting to see what happens. And there's this cat and mouse game between companies hitting great numbers, right? You saw the quote from the Alcoa chairman basically saying, I don't know what's not to like, and yet the stock was down 6%. So it's this disconnect sometimes between what investors are expecting on Wall Street, the whisper numbers and all that other stuff, with actually what the companies deliver. And we've seen huge earnings growth over the last year, and now all of a sudden they're starting to moderate. And so Wall Street's sort of potentially overshooting, and that's one of our worries.
We're seeing, though, you know, the big banks develop a pattern where they are reducing loan loss provisions and boosting revenue on that account. Is that a concern for you?
Well, it's probably reasonable given where we are in the economic cycle, but it's certainly not basic revenue growth. I mean, it's just the kitchen sink.
Nothing to cheer about.
Nothing to get particularly excited about. And it should be reasonable. Again, I haven't looked at JP Morgan specific numbers, but you know, at the end of the day, things are better. People are paying their bills on time. Companies are paying off. So yeah, you would expect loan loss reserves to be getting smaller.
Michael, you said you worried about Wall Street kind of overshooting.
Yeah.
You mean that their expectations are too high here,
Correct.
or what? Okay.
Correct. So
the numbers aren't necessarily that bad.
They're not bad. No, they're not bad. Bad compared to what? That's the only question. And so, right, Wall Street's really good at extrapolating last quarter and extending it like 3 years, right? Which doesn't work very well, particularly at inflection points. And I think we're at an inflection point where we're starting to see this huge rate of growth over the last two years, really from the bottom of the GFC, the global financial crisis. And now we're beginning to level off a little bit.
A new acronym,
the GFC.
Related back to the markets, though. So what does it mean for the markets then?
Well, I think it means it's we probably have some tough sledding ahead of us. Not tough sledding. I think just a little more choppy. You know, we've been on really a 9-month run. September 1st, the market was up something like 2.5 or 3%. It was after a tough summer. Bam, September, first trading day in September, the market took off, and we haven't looked back. We've had 4 or 5% correction that whole time.
Despite everything going on in the world.
Besides all the huge macro events that are causing all kinds of trouble. So, you know, one is it's just, hey, it's 9 months. We've got to be a little tired here. And secondly, we think, again, this annualization of earnings growth and beginning to moderate in year-over-year earnings growth is going to start to take its effect.
I noticed something interesting in the notes here. You've been selling a little bit of oil, agricultural commodities, silver. All of these things have done obviously incredibly well. Are you just taking a little bit of profit off the table, or do you look for a downturn?
Are you becoming a little bit bearish?
Bearish.
Because when I read it, it felt like.
Yeah, it's funny. You know, we get paid to invest on a risk-adjusted basis, right? And so everything we look at, whether it's silver that's up from 16 where we bought it to 34 or 38 or wherever it happens to be, is, you know, the question is what's the risk going forward? And clearly it could run to 50. Everybody's talking about silver running to $50, but at the end of the day, what's the risk inherent in getting to that 50? And we think the risk-reward profile is just changing on a lot of this stuff. So oil's not nearly as interesting at 110 if you're on WTI or Brent versus you know, the $80 where we added and overweighted our position. So it's just time to take a little off. We think the risks are higher, and it wouldn't surprise us to see a pullback in the market.
But you say you're about even weight as far as emerging markets are concerned, and that's your only risk asset that's not underweight.
Yes. Well, that's because they've underperformed, right? I mean, EM's underperformed for the last 6 or 9 months or so as the developed markets in the U.S. have led the way. China's been tightening, so you know, the interest rates, everybody's been sort of worried about a slowdown over there, and the markets behaved, and now all of a sudden they're beginning to perk up. So.
You say, you know, your best guess is that the market struggles over the summer. Is it because also in terms of what the Fed does and backing off of QE potentially?
Well, that's certainly another variable, right? We don't expect QE3, heaven forbid, and so you know, once they start to take that away, I think you're going to naturally see a shrinking of the money supply. And look, at the end of the day, this whole financial thing that the Fed's worried about is going to depend on whether the banks start to lend money. Right? If the banks begin to lend, they take all this really good capitalization they now have, they've rebuilt, and they've got to start lending. And when you start lending, then the money supply grows. So we're not inflationary until they start to lend.
Let me get to one point. President Obama presenting his plan to cut the deficit long term. When you were on Street Smart back in February, you weren't too happy with the progress that Washington was making. Listen to this.
It's critically important for the competitiveness of the U.S. economy for the political jerks to get off their seats and get some work done here. Why is this complicated? Right, we're spending a bigger piece of our GDP in deficits than we almost ever have. This is not a difficult problem. It's simply political will.
I tweeted on this because I loved it. I mean, can we fix this problem? Do you expect it quickly?
Yeah, I don't think the problem is going to be fixed quickly. The real important thing is simply progress. And
are we going to get that progress?
We're a bit encouraged by some of the attention that's being paid here, right? So I would love to take credit for some of that attention. I don't think it happened, but at the end of the day, the country has to see, the political leadership has to understand that it's not about spending your way to prosperity, but it's about balancing your budget, much like we all have to do in our families and our organizations we're part of. So it can happen. You saw Trichet's comments about the U.S. and discipline and the need for the U.S. to get more discipline in their financial matters, right? So the rest of the world's looking at us and saying, let's go. Let's get something done here. We need to take it seriously.
Okay.
Maybe we're seeing a bit.
Got to run. Great to have you here in studio. Michael, thank you so much.
Thanks.
Stop by anytime.
Thanks for dropping by.
Okay, guys.